Money market funds that lend to private sector borrowers experienced large withdrawals during the financial stress of March 2020. Building on the literature about the underlying drivers, we find that large investors paid little attention to the liquidity conditions of individual funds. In this sense, they appeared to be preoccupied by their own liquidity needs. In response to the withdrawals, fund managers disposed of their less liquid assets, which may have contributed to market-wide liquidity shortages. The Federal Reserve's money market mutual fund liquidity facility reduced the cost of liquidity accumulation and allowed funds to replenish their buffers.
The dash for cash in March 2020 also led to severe strains in dollar funding markets. Since then, funding from money market funds has not recovered. This episode seems to have changed the way non-US banks source dollar funding. In particular, while increasing their dollar on-balance sheet liabilities overall, these banks now rely less on money market funds and more on deposits from other non-bank financial institutions. So dollar is still king, but changes in funding relationships could have implications for the functioning of dollar funding markets.
Finally, bond exchange-traded funds saw extreme price swings in March and April 2020, trading from steep discounts to large premiums within few days. The arbitrage mechanism, which keeps share prices aligned with the value of fund holdings, works differently for bond than for equity ETFs. Because of the illiquid nature of bond trading, the basket of assets used for creating bond ETF shares differs from that used for redemptions and comprises only a small subset of the assets actually held by the fund. These unique features allow bond ETFs to absorb shocks and could even discourage runs.